Good evening. Welcome to the award-winning cafe community. I'm your host, Cheryl Noble, and our program takes a look at people who make a difference in our community, as well as our incredible resources and services that make our community a great place to live. My first guest is a realtor with Century 21 Gold Dust Realty. He's also a monthly columnist for Nevada City Advocate newspaper, and he's an expert on our local real estate market. So a warm welcome back to the program to Paul Sieving.
Thanks, Cheryl. Good to be here again.
Thank you so much. And let's start with your article that is now out in Nevada City Advocate about where we came from the last couple of years and a little bit of trends and forecasting. And you mentioned we fared well.
Well, it's all relative, you know, compared
Yes.
to what? And the way I look at those numbers is compared to other markets where there's a lot of flat land, and they tended to be overbuilt rather dramatically during the peak of the market.
Mm-hmm.
So we see a lot more distress there in terms of the percentage of homes that are underwater or bank owned and that sort of thing.
Mm-hmm.
So compared to the whole state of Nevada, for example, where approximately 40% of homes are negative in their mortgage, they're underwater, as we say. Here in Nevada County, across the state line, it's more like 25%. So that's, again, it's all relative. Everybody's hurting right now, but we should feel a little bit blessed because we haven't really taken the pounding that some other markets have taken.
Yeah, we didn't have the sprawl.
Yes, exactly. We didn't have
the
the rampant overbuilding
overgrowth.
just because of our terrain limits that.
Yeah. Well, I know that you brought along, which we'll show in a little bit too, some graphs and graphics that shows some of the metrics and where our prices. That was one thing you touched on too.
Yeah,
last year.
you know, we want to choose a couple of important.
Do we want to start on days on the market? This is the first graph on there.
Yes.
Okay,
we choose a couple of important measurements to let us know, trying to understand how the market's doing. And what we can see here is that at the top of the market, days, or rather at the trough of the market after the big decline, days on the market were about 150 on average.
Mm-hmm.
You know, that's nearly 5 months. And today, days on the market are back to about 60, only about 2 months. And that's a much more normal, if normal means anything anymore.
And yeah, that drop is a good sign because
It
it's
is.
less days on the market. And so what's that time span? How many quarters, or is that within the last 15, or you said 15 months?
Yeah, that's 2 years we're looking at on the graph right there. It's a
Yeah.
two-year span from the beginning of 2009 to the end of 2010.
Okay.
And during that time, the absorption rate, what we call the absorption rate, the rate at which homes are bought off the market, has really picked up. So that's a good sign.
Yeah, that is a good sign, particularly if you're thinking about selling, and it's good to know that it's not going to be sitting for a long time.
True.
So, all right, let's go to the pricing then, which was always kind of the big hurt in all of this.
It is. That's the one we feel personally as homeowners, and the pricing and the days on the market are really related. When we're in a period of steep decline, everyone who's got their home on the market is they're chasing these falling prices, chasing them down and down, and so that's why it can take a long time for a home to sell. And what you can see from the graph of the last 2 years of pricing is that the rate of decline has decreased dramatically. In fact, it's almost what you'd call level, and you can even see that in the summer months of each year, the price is trying to come up again. So that's a good sign. So you can see that seasonality, which we, in a market that's not being battered by external forces, we'll see the seasonality.
So the exception was an economic market and not ruled or patterned after seasonal, like summer's a hot time and slow in the winter.
Exactly. Those are typical internal forces in the real estate market, and when you get some major, misallocation of assets like we had over the last few years, that's an external force on the market, and it'll cause steep rises or steep falls, and the seasonality disappears from the data. Yeah, you can't see it.
It's all the off season.
The big wave wipes out all those little ripples. Yeah,
the off season. So look from looking at that graph, then that we're kind of at the the bottom, it looks like, or it hasn't gone any lower.
It looks like, here's just for example some numbers. In 2008, our local market dropped 20%. In 2009, it dropped about 14%. In 2010, it dropped about 8%. So that's, you know, you can see the graph bottoming out. And I don't make predictions, but I think it's reasonable to expect that we'll see little or no decline in 2011.
Oh, okay.
That's just a reasonable expectation. We'll see how it plays out.
A reasonable, very optimistic, and I'll take that as a, as a forecast here, that it's kind of, well, it feels like, there was an article in the Union, I think just last week, about that they, prices have been, are at their, they seem to be stabilized.
They do. You know, the rate of decline has really gone almost to zero, and we're at a point now where I think, you know, we're just kind of bouncing along the bottom. And, you know, it depends on whether you look at strictly local data, like I do in this report, or at more regional data. And it's easier for us to sort out what's going on right here at home if we look at strictly local data. Right.
Well, another big concern is the number of foreclosures, and we bottomed out with that because that's a real.
It's really important, yeah. And we're in a period of time where there's a tremendous number of foreclosures, you know, coming towards us or actually on the market at this time. And in order to really recover a healthy market, we need to dispose of those, get them back into private hands as efficiently as possible. What we're seeing is that approximately 50% of all sales in our market are distressed properties, either short sales or bank-owned properties.
50%.
50%. That's a really huge percent. That doesn't reflect so much on the total housing stock, but just what's on the market. So we're seeing of the homes that sell, about 50% are distressed in one way or another. That's come up. At the beginning of this downturn, you know, it was, you know, 5% or less, and it's come up.
Yeah,
we're seeing it leveling out a little bit at, you know, around 50%. Some dips and rises, and what we need to see in order for a really healthy market to start rematerializing is that distressed sales rate to come down maybe to 25% or less, and then when we see that, we'll have a pretty good feeling we've made the turn.
Okay. So and you're feeling good about this year.
Yeah, so far so good. And the bottom line is we're able to absorb a 50% distressed property factor, and the days on the market keep going down. Right. So that tells me that we're still an attractive community, that the buyers are coming here, that the smart money's coming into Nevada County.
And it's beautiful. We're not living in sprawl.
We're not, or even in snow this year.
That's right, a beautiful winter day. All right, well, we're out of time, and thank you so much for coming on, Paul. All this is good information, and we can look forward to a good year.
We're certainly looking forward to that.
Good. Thank you so much. All right, so we're going to take our first break. Stick around while I bring up my first artist.